Hi,
Hello.
everyone. Welcome. Good afternoon. We're excited to do our Q1 2023 update.
Yeah, we've got 66 slides to cover in the next hour and a half. So we're gonna dive right in. Before we jump in, is there anything anyone wants to celebrate or share? And as always, you're welcome to pipe in with questions. We're gonna do our best to record those. One of our producers will record those, Rachel, as we go through. We want this to be an interactive thing as much as we can, while we're just letting everyone know about all the exciting things that are happening in our neck of the woods in Fund 1, Fund 2, and the Tech Fund.
Absolutely. So chat should be active. The Q&A section is active. Chat's great. Rachel's monitoring that. She's moving things over to a document so that we can address those. Definitely feel free to get your questions in. We love questions. We want this to be the most valuable use of your time, and we want you to get the information that you want. So as you put those questions in, as we're able to address them throughout the presentation, we go ahead and do that. Anything that kind of doesn't fit in, neatly, we address at the end. But kind of our commitment to you is that if you ask a question, we'll make sure that that gets addressed. Yep. So without further ado, let's go ahead and get started. I will reshare our slides here. All right, so here we go. This is our Black Swan Q1 2023 update. Certainly as we were preparing, last night and into today, it feels like these quarterly updates are like a year of updates. Like we have we have big numbers to share and big things that have happened. And just so grateful for our team members, for our residents, for contractors, just everyone that plays a part in this. Nick and I get the privilege of presenting this information to you, but there's so many people working to make this mission possible, and we're just so grateful to all of those folks.
As usual, we'll start with a disclaimer that we're going to talk about our business plan, and anytime you see things involving projections or pro formas or performance, you should always seek the advice of your counselors, whether that be a CFP or a CPA or attorney. We're none of those things. I am a licensed real estate agent, but not qualified to advise you on such matters. So be sure to check with your advisors.
Absolutely. A little bit about us. Most of you know us by now, and in the interest of time, we'll go through this quickly. We're still at right around that $1/3 billion in assets under management, very vertically integrated. So we raise our own capital, we have our own asset management, we do our own property management. We're going to share some of our property management updates as we go along. We're going further and further down that chain of vertical integration so that we can really care for our properties at the level that we want to care for them. Really care for them as an owner would, and drive that quality, efficiency, cost savings. We've raised about $60 million in capital. Lots of you are asking about Fund 3. I do anticipate that will open sometime this summer. We don't know exactly when. We're working with brokers and some other folks on getting our next acquisition under contract. And I've joked with people on the phone, like, we've been doing this long enough to know that the phone may ring today and someone will say, that conversation we've been having for the last 5 years, I'm ready to sell and I need to sell in 45 days. That could happen. It could be that we get something under contract with, 180-day close window. You just kind of never know. But if I'd had to anticipate, I think Fund 3 will open sometime this summer. We have our real estate sales team. I'm very excited that as part of Gary Keller's mastermind, I'm actually flying to Austin next week to get to spend some time with Gary and many other top performing real estate agents and team leaders. So just super excited about that opportunity. And then I will be in Austin. So for those of you listening that are in Austin, we're going to have a nice get together at a dinner one night. Rachel has all the details. I'm super excited about that. And then, as always, Stonehaven continues on with our $40 million ground up construction project. And then we have lots of other new construction irons in the fire, and some of them we'll be able to share today.
Mm-hmm. We want to celebrate, we're over 1,000 doors, over $1/3 billion assets under management. This was something we celebrated in our last kind of quarterly update. And this is, I don't know, those just feel like really big numbers that are exciting to celebrate. It certainly gets us to a place where we have economies of scale that just weren't available to us before. We're, bringing lawn and snow in-house, actually buying hundreds of thousands of dollars of tractors and trailers and trucks and equipment. There's lots of really, really cool stuff that we're able to do as we get to a larger scale that just wasn't available to us before. And it's just going to allow us to drive even greater value to our investors.
Yep. And last quarter, we shared that we were over 1,000 doors. And this quarter, we are right at almost 1,000 doors right here in Rochester.
Yeah,
so in addition to our Tacoma portfolio, based on the stats that we have, there's no ranking board or publicly available information, but there are rental certificates in our community. And so it's pretty easy to piece together how many rental certificates are assigned to any given property management company. And it's our belief that we're now the largest single housing provider in southeastern Minnesota. So just, if that's true, which I think it is, as far as I can tell in the data, if we're not the first, we're certainly second or at most third, but just excited to be able to have that place in our community and to really have that commitment to our community to build healthy communities, renovate buildings, take great care of people, have excellent customer service. We met with our leasing team this morning for almost 4 hours, just really talking to them about the level of customer service that we expect, about serving our ideal client, meeting their housing needs, knowing that moving is stressful. If you're moving across the street, it's stressful. If you're moving across the country, it is a life-changing event and very stressful. And, that we're so privileged to have the opportunity to serve those people in that time of need. That's where the property management company came from. So when Nick and I relocated to Rochester, we had 3 dogs, a 9-month-old baby, and we were coming here from Mayo Clinic. And it was a scary time in our lives, uprooting our life, leaving behind everything we had created in Oklahoma, going to a new place with a new baby. And we just love having the opportunity to kind of serve the earlier versions of ourselves.
Where it all came from.
Absolutely.
We always love to touch on our core values. We're going to speak to those today. We're certainly growing authentically, some very humbling amount of growth in terms of the number of full-time employees that we've hired, have some absolute, rock star individuals. Just brought on just a top-notch construction manager who's going to help with some of our new construction projects and wrap up some of our other remodel projects. And we hope that, we're embodying servant leadership. We felt like we got a real opportunity to practice that today with our leasing team. And, we're not above making leasing calls. Elaine and I, during the peak of the high season, I have done probably 21-hour, one-on-one sessions with different leasing agents in the last couple of weeks. And we're going to be doing even more of that in the coming weeks. This is, the sun's shining, we're making hay. So we love to embody servant leadership and lots of other values that I'm sure you'll see. Radicalizing transparency certainly being the biggest one, just with the way we approach these webinars altogether. This isn't a 15-minute, boardroom coat and tie type of affair. We're showing up for you to just serve you and make sure you have all the information that you need and feel excited about your investments here in Black Swan.
Absolutely. Right. So some exciting announcements. We wanted to, put these at the top so that if you have to run for lunch or you're listening kind of podcast style, you get the exciting stuff right at the beginning. So we've had 2 major closings in Q1. The first is Residents at Discovery Square. That's a deal we've been working on for a while. Assuming the in-place debt, it's 2.37%. And so the bank didn't want to give that up too easily. The bank, kind of kept insisting that we just, get a new mortgage on it. And we just kept kind of insisting back that we wanted to assume, that really favorable debt. And that's ultimately what happened. So we're very excited about that outcome, very excited to bring that asset into the portfolio. That asset is shared 50-50 between Fund 1 and Fund 2 because it's such a large asset. And then we also closed on what was formerly named Colby Manor. We've, kind of gently rebranded it to the Colby. In and of itself, it's not the most exciting asset. It's a 29-unit Class C apartment building, but its location is amazing. It is right on the same street as Mayo Clinic, less than, probably a 90-second walk away from the door of Mayo Clinic to get there for work or for treatment. Very excited about the short-term potential of that asset. We'll do just some mild renovations to make it a great place to live. Excited to put our name on it. But ultimately, the value of that asset is in, years-long redevelopment play, putting a very grand, as many units as we can fit with the new building code, multifamily building on that parcel. So just really excited about that. We are under contract on 2 amazing properties, Kensington and Lauriston. They're not quite actual next door neighbors. There's Kensington and then a different apartment building and then Lauriston, but kind of shorthand, you can think of them as next door neighbors in terms of sharing economies of scale and efficiency with leasing and maintenance and all of those things. Today, they're Class C buildings that are in need of deep renovations, which is, of course, why we love them, in an A+++ area in Tacoma. Very excited to have 2 new assets in a bit of a different location in Tacoma. Our other assets are not right in downtown Tacoma. They're all clustered just, a few miles away, kind of closer to the water. And so we're very excited to have, like, it's all about location, right? It's all about the dirt. It's all about the neighbors. And Kensington and Lauriston are going to be a really great acquisition. Those will go into Fund 2. And then we have some distributions coming. So our first Fund 1 distribution is coming this month. We endeavor to get those out in about 7 to 10 days. So please go to the InvestNext portal and make sure your banking information is in there. Just blackswan.investnext.com. You can ask Rachel for technical support if you need that. We want to make sure that when we click that, send button on the distribution, that money gets right into your bank account seamlessly. And then we have a tech fund distribution coming up as well here in the next week.
Yeah.
Anything else you want to add for our
We're going to dig into
announcements?
those in more depth later in the show here, but it's been a very busy Q1 to say the least.
It has been. Yeah, that's why I said it feels like it's been a year in a good way.
Yeah.
In a very good way.
Yep. Some frequently asked questions. So, one of those common questions we're getting asked right now is, how do I access my tax forms, my K1? So, you've got a few bullet points there, but if you're listening in podcast mode, everything is coming to you from Safe Send Returns. You can also view your K1 in the InvestNext portal. So those are available for Fund 1 and Fund 2. And then we anticipate the Tech Fund K1s to go out in the June timeframe. Next is, when is the next fund coming? As Elaine said, it just depends on acquisition flow. We've got a bunch of different deals we're working on, but you never know when those are going to kind of break loose. At this point, we've more or less accounted for all the capital in Fund 1 and Fund 2. So whenever another acquisition comes along, we're expecting that we'll fire up Fund 3. But it just, we're waiting for the right opportunity to come along to kick that off. When is the next in-person event? So September.
Super exciting.
Yeah, September 15 to 17 this fall. I'm sure Rachel will put a link there. There it goes, right on cue. Real Estate Real Life 2023. You can jump on the wait list right now. I recommend you. So we had a blast last year touring assets, doing tons of mindset work, and it was a ton of fun. This is a question I've gotten a lot in the last couple of weeks. We've done a ton of investor calls. Is it too good to be true? Why are there no fees? And ultimately, we just want to have complete alignment with our investors and put our investors first. We think that if we do that, everything else is going to take care of itself. And we forego a lot of compensation on the front end of the deal, so to speak. But fortunately, we started this having enough money, not needing to get that fee income on the front end of the deal to put food on the table, so to speak. And so we love the model. I've talked to other GPs all the time, trying to spread the good word if I can, and see if other people want to adopt the same model. But that's why we set that up the way that we do. An infinite rate of return is basically that's the essence of our business model. That's when you have a golden goose. So you've gotten to a cash out refi to return all the initial capital that went into purchasing that asset. But you get to keep that asset for the indefinite future. You get the cash flow and debt pay down and appreciation and tax advantage of that asset for the indefinite future. When you get to that infinite rate of return in our last FAQ, this is a huge one. This is like the doorknob question for a lot of investors. What about interest rates? So I have a prediction. You can write this down. Just looking at the Fed speak and jobs numbers and stuff, I will be blown away. I think there is a 0% chance of interest rates being this high.
You should at least give yourself like a 1%.
No, I'm going to say 0%.
You feel confident in this prediction.
Interest rates will be headed down by the end of the year. The Fed will have a rate cut before the end of the year. So go ahead and jot that down in your calendar. You can check, December 31st and see if I was right or wrong in that prognostication. But that's just, when you look at the macro economy and everything that's going on, that's just all the signals are there. Despite that we just had a rate hike last week. I think that's what's going to be the case. But we really set ourselves up for success by getting tons of fixed rate debt. So we don't have any floating rate debt. We don't have any caps that we need to pay. We don't have any predatory loans from Wall Street, any predatory bridge loans. We've worked with regional banks for 100% of the loans in our portfolio, which requires us to sign full recourse on the note, which is a huge amount of skin in the game, so to speak, that we have to have 10 or 100 times more than a typical GP might have in a deal, but allows us to get just exponentially superior loan terms. We're working on Kensington and Lauriston, and we're trying to hone in, our rate there. I think we're at maybe 6.3% or something like that. That's fixed for 5 years with no prepayment penalty. If we went a non-recourse, bridge loan route, we might be looking at like a 9% interest rate plus amount of additional legal costs. Again, we have to sign for recourse on that note, but we think it's the right thing to do. Most of our portfolio is at, very attractive interest rates, 4 or 5%, fixed for 5 years. And while a lot of syndications are struggling right now, potentially doing capital calls, we are going to be able to do distributions because we got that fixed rate debt. And so we're doing really quite well given the current economic circumstances.
Couple of really good questions came in. When do we first estimate a distribution from Fund 2? So in general, our business plan is that distributions will start about 18 months after a fund kind of is first born, so to speak. So I anticipate Fund 2 distributions will start around Q1 of 2024. And the reason for that is in that first year is when we're acquiring properties, pushing vacancy, doing renovations, common area improvements, all of the things that eat up capital. And then about a year or so in, those renovations start to stabilize, new residents move into those units, cash flow starts to improve. And so that's where that 18-month window comes from. And then someone asked a great question. Do we offer any opportunities to invest on the debt side? At this time, we don't, but it's something that we historically have done. And then it's something we will likely bring back in the future so that people can have essentially a kind of a fixed rate debt option that, you know, if they want the stability or whatever it is in their portfolio, and then also the equity side, and, you know, people can choose one or the other, or a little bit of both.
That's been a super common question I've gotten. Almost should go in the FAQ, but we would love to give people a fixed rate option, you know, offering there.
Absolutely. All very good questions. Keep them coming.
Yeah.
All right, let's jump into Fund 1. There is beautiful Nicholas building there if you're watching your screen.
Yeah. Lots of fun things going on at Nicholas, and Nicholas is great because it's, you know, essentially the oldest asset in our fund structure. Now, we've done this exact same business model for years before the fund structure, exact same terms, just with smaller joint venture partnerships. But you get to see what things look like as assets mature. That's where this long-term hold, you know, thesis, it really gets exciting. So
it actually gets quite boring.
Yes.
Like I was thinking about our presentation today. You know, we've done, I think, like 6 presentations on Nicholas, and like we don't have a lot to report. Like rents are high, renewals are good for people that are moving out. We're able to fill those units very quickly. We're able to continue our rent escalations beyond our pro forma. Kind of all the same stuff we said last quarter, and the quarter before that, and the quarter before that. So I agree with you that this is where it gets exciting, but it's exciting because it's boring, right? Yes. An investment that's a roller coaster is an investment that turns into capital calls and losing money and all sorts of things. An investment that's just quiet and steady and just performs day in and day out, that's where real wealth comes from.
If we were, you know, worried about hitting some 3-year exit on this asset, we'd be like, oh, shoot, you know, cap rates are up, interest rates are up, you know, are we going to be good to sell this asset? We have 7 years of no interest, no payment debt, $10 million, no interest, no payment debt on this asset. So we're not worried about that. We're set. We're you know, kind of printing money on this asset, so to speak, and it allows us to just focus on operations and delivering the best possible outcomes we can to our tenants and to our investors. So we've had an extraordinary high renewal rate, 78% on this asset. In addition to that, it's our strongest performing you know, asset in terms of new leases, which makes sense, right? Because it's kind of our most stable asset. So a lot of our assets are job sites. You know, when you're doing a tour, you hear, you know, saws cutting and hammers pounding in the background. It's harder to show and lease those assets. Whereas Nicholas, we did that. We had, you know, I think a dozen different contractor vehicles of that asset. You know, one day when I was walking it, and now the name of the game is to retain the high quality tenants that we love and try to bring as many of those people as we can up to market rates, you know, slowly and steadily, so we don't, you know, instigate too much vacancy, and then just place a, you know, a reasonable number of new leases to really kind of optimize our different sliders of vacancy and ultimately, you know, gross potential rent or gross effective income for that asset. But it's been a really quiet asset, you know, really low vacancy. You know, one downside is, you know, property taxes have gone up 100K, which that happens. You know, we you know, kind of penciled that in as a potential future opportunity for our pro forma. It's difficult to predict exactly what's going to happen with taxes. If taxes go up again next year, we'll challenge those, but the taxes, unfortunately, are, you know, we're low enough to start with that, you know, we can't really argue the increase that's been there already. And then just a little box there on our internet upgrade, which is now complete. So, you know, back in our most recent update, we talked about how we were actually rolling that out. That's now rolled out, and man, it has been just a light years improvement for our tenants. This was our #1 kind of CSAT sore point on this asset, was the in-place internet offering was not great. So we went from, you know, 30 download, 10 upload to 1,000 download, 1,000 upload. So just, you know, radically superior option there. You know, new leases that go out all include this Wi-Fi charge. And in addition to all that, we're able to reduce the cost by $20 per unit per month. So this, you know, just plain and simply accounts to $20 per unit per month in additional income, which we've got some math there. That's $1,900 total for the asset per month. 12 months in the year is $23,000 per year in additional income or additional net operating income. And at a 5 cap, that would be $456,000, $500,000 additional asset value that we've been able to generate by a somewhat painstaking contract negotiation process. I've worked on that contract for 6 months, but the juice was worth the squeeze, and we're seeing that bear fruit here with Nicholas.
So we've shown how with the internet upgrade, it was about $500,000 in asset value increase. And then in our previous updates, we talked about the parking lot and how we're able to bring on new parking spaces. And it's just all these efficiencies and optimizations in addition to, great property management, rent escalations, taking great care of people, managing maintenance really well. So let's talk about our performance at Nicholas as compared to our pro forma.
Yeah.
If you're able to look at your phone or your screen right now would be the time, but I'll try to
critical slide for anyone to see.
I'll try my best to describe it all verbally. So in place rents at the time of acquisition for a studio were $1,000, and for a 2-bed, 2-bath were a little over $1,500. The projected rents that we had in our pro forma were fairly modest increases in rent. And in fact, we actually thought we could get maybe a little bit less for a 2-bed, 1-bath. So the seller was getting $1,465 and we had penciled in $1,450. You can see there our projections were $1,050 up to $1,600. And then our Q1 actuals in 2022, which was the very first quarter that we had this thing. We closed on this either December 27th or December 28th of 2021. So in Q1, it was still a bumpy road. We were still getting residents onboarded into our property management system, really learning the building, learning all of the maintenance quirks and those sorts of things. But right out of the gate, our actuals for studios were $1,300. And then you can see the amounts there up to our 2-bed, 2-bath were $1,700. So we blasted through our pro forma like weeks after we acquired the asset, which I definitely never want to set the expectation that that's always what happens. But I will say that Nick and I, our personality is our pro formas are sort of like, if that's like the best we could get, we would still be happy. We tend to set the like everything could really be going poorly, but we could still get these numbers and we would be happy. So we're unsurprised that we came in, so over our pro forma, just immediately after acquisition. And now a year later, our actuals for a studio are $1,475, all the way up to a 2-bed, 2-bath is at $1,775. So we're just, so far ahead of our rent projections than we, expected at closing. This asset's in really great shape, performing really well. And it seems like the sky's the limit. Like, we are still in what is called price discovery. That's a term in economics, which means, basically, for all intents and purposes, every unit at Nicholas is spoken for the rest of the year with renewals, or, we know that, person A is moving out, but we already have person B assigned lease and security deposit paid. There might be a few stragglers, but for the most part, Nicholas is spoken for the year. So we don't actually know how high we could push rents because we haven't had an opportunity to push them so high that people say no. That's when you know that you have discovered your price, is when you start getting no's in the market. And we haven't reached that yet. I think it could be years before we hit that spot.
And it's a gradual process. Our biggest challenge with Nicholas which is a great problem to have, is that price discovery is taking so long. So to take a studio unit from $1,000 a month to $1,500 a month to $1,475 a month, that's not something you want to just snap your fingers and achieve overnight. So we turned over half of the units in Nicholas last year in like a 4-month period, which is a really intensive thing. And there's a little bit of risk associated with that. If you overshoot it, you could end up with, more vacancy than you expected. Maybe rent growth isn't as, high as you thought it might be. Our renewal rate is so high and our new rents are so stable and our leasing performance is so strong. We know that if we could turn back the clock, we could probably push escalations a little bit harder, but we would always rather kind of err on the side of caution. I mean, if you can call turning over half the units of an 100-unit apartment building in 4 months conservative, there's some universe where it would make sense for us to just kind of escalate everyone to full market rate all at once. But we think that's probably not the best thing for our community. It's probably not the best financial outcome for our investors. It's probably not the best thing for the building. Tenant turnover is hard on a building. So, I mean, it's a fantastic problem to have, but our biggest problem right now is just, okay, so do we do like 20% per year escalations on that, hypothetical studio person? Do we, do 15%? Do we, how do how do we make this as seamless and as efficient a process for everyone involved that just gets the best outcomes for everyone involved?
Absolutely. Here's a little bit about parking.
Gosh, I wish I was not still working on this. So Nicholas is in a ridiculously good location. This isn't a location where they knocked buildings down to build an apartment building. This is a location where they picked up houses and moved them to build an apartment building. It's a historic neighborhood with a strong neighborhood association, all sorts of restrictive covenants, lots of sensitivity from city council. Adding parking units to a historic neighborhood is a challenging process. So we're very painfully slowly working through adding, 5 parking units. So you might say, gosh, Nikki Lane, your time's so valuable. Why the heck would you spend so much time on 5 parking units? Well, if we add just 5 parking units to this building, let's say that costs us $10,000. We have some math there. That adds $150,000 to the value of the building. And to boot, it actually makes the building more valuable because we're able to attract more premium tenants when we have more parking availability, people who have cars or households that have 2 cars. We've additionally implemented a utility bill back fee. This is how we went from like the $1,500 to $1,575 in that last slide. So $75 per month utility fee for all of our tenants. And critically, this includes heat and air conditioning as well as water, sewer, and trash, because there's this ultra high efficiency heat pump HVAC system in the building where the landlord pays both heat and air conditioning. So it's just a tremendous value that we're able to offer our tenants that's still more affordable. It's a better deal, so to speak, than they're able to get anywhere else in town. So that value add, by itself adds probably about $1.7 million to the value add of the asset, in addition to the $150K value add from the parking and the $500,000 value add from the internet. It takes 12 months to cycle through leases and get all these things rolled out to where these reflect all the current leases, but just massive value adds that we've been able to implement on this asset, adding huge value to the tenants.
Absolutely. Next up is Rochester Homes Fund 1. Again, pretty boring update for this quarter. So in the last several quarters, we acquired all these properties, did all of our renovations, moved people in. We have 1 property right now that since the time of acquisition, a person has been in that property, and that person moved out on May 1st. So we're just starting the renovation for that one. But other than that, this is kind of bread and butter. This is what Nick and I have been doing for well over a decade.
Mm-hmm.
The main thing to report for our single family home portfolio is that our expense ratio is right at 40%. So a very lean operation for what is called scattered site management, where these single family homes are all over the community, and very strong lease renewals with strong escalations. So just a solid, I kind of think of like, Nicholas is one asset, the single family home portfolio, I sort of think of that as like one combined asset in my mind. And then the portion of Residents of Discovery Square that's in Fund 1, that's like the 3rd asset. So 3 rock solid assets in a $10 million fund. Like that's certainly outcomes, we're very proud of, to put together a package like that. So nothing earth shattering to report on the single family homes. They are just, doing their job, providing amazing housing for people with minimal expenses and strong lease renewals. We have some pictures. We try to change them up every time.
Love our
just show
houses.
different
That was a
things.
full, that last slide was a full remodel. That was, a Class D property when we bought that. We did a massive value add to, and the individual who did that renovation is now a full-time W-2 employee of Black Swan. So really excited to have that expertise in-house, just extraordinarily high quality work.
Yep. And then fixed rate debt, nothing over 5.15. And that's not just for Fund 1, that's for our entire portfolio. Everything in Fund 1, everything in Fund 2, all of our legacy JVs, all the stuff that Nick and I own personally, everything is fixed rate. Nothing is above 5.15. It's likely that Kensington and Lawrence is going to come in the low 6, as Nick mentioned. But today, as we stand, nothing above 5.15.
Yeah.
Some good questions came in about Fund 1. Is the latest acquisition of Discovery Square the last acquisition in this fund? Yes. So as I just said there, Nicholas, the single family home portfolio, and then Residents of Discovery Square, those are the 3 assets that are in Fund 1. There will be no additional acquisitions in Fund 1. Are the rehabs complete versus planned? Are we on track or behind with costs and timeline? So for Nicholas and Oliver, we did about 12 renovations of units in those buildings, and that's all complete and done. And then our single family homes are all complete and they're already cashed out.
Mhm.
We've already done our cash out refi, including the one that I mentioned that we're just starting the refi on. Because we have such a great relationship with our banks and because we've done this a million times, we were able to cash out that loan home with the after repair value, the ARV, as part of the whole portfolio, because we didn't want to hold up that whole cash out refi on that portfolio just for one single renovation. So with that, that one renovation aside, for all intents and purposes, the renovations are complete and there won't be additional renovations. It'll just be, kind of normal maintenance at this point. And then we will talk about our plan for RDS when we get to those slides.
Mhm.
Um,
One clarification I'll mention is we did a light renovation to every single Nicholas unit that we turned over.
yes.
So they all needed, I'll say $5,000 on average,
Mhm.
just.
It was a 7-year-old building.
Yeah. So it was just ready for, some new flooring, all new flooring in some units, other units still looked pristine. There's scratches on this cabinetry. We need to touch this up. We need to, we repainted a ton of units, repainting common areas, that sort of thing. So it was just a crazy renovation push last year when we were aggressively turning over so many units. This year it's lighter. We only had to do kind of a deep renovation on about a dozen units. So I would say overall, we're kind of right on track for Nicholas and for Fund One. And yeah, we've got some stats we'll share for Fund Two. It's pretty mind blowing the renovation outcomes we've had for Fund Two.
Yep. Our NOI for Fund One, as we showed, we didn't show the NOI there, but we showed the rents that we're getting for Nicholas. We are far exceeding all of our projections, far exceeding the projections that we had for our single family home. And then RDS is a big part of that. And that's coming up. We want to talk about distributions.
Yeah, let's do it.
Kind of the big question
Yeah.
for our fund.
We're bearing the lead because we get all excited about our boring stable assets and new acquisitions, but this is what the investors want, is distributions. So.
Yep, you go for it.
Yeah, so we anticipate doing a 10% distribution and for all Fund One members in the immediate future. Please do make sure your bank information is up to date in the Invest Next portal, and that distribution will be coming your way soon. And then we'll probably fire up quarterly distributions thereafter. So, more or less as expected, the portfolio for Fund One has matured and we're ready to start doing distributions. We probably could have done distributions sooner. We wanted to hold off on that because we were acquiring RDS in Fund One as well as Fund Two. So we just wanted to have kind of a huge amount of cash on hand in case we needed it for closing on that epic asset, making sure that we're able to capitalize on that opportunity. That was a long closing, 6 months to kind of arm wrestle the bank and everyone involved to get them to agree to assume that in-place debt. But we're so grateful we did. And then we expect, very modest quarterly distributions for Fund One thereafter. And at some point, a year or two from now, we'll probably do a cash out refi on the single family homes in Fund One. And that will be a significant bolus of capital. And there was a question about, how soon would we refi Nicholas? Not for a long time. When you have, $10 million of interest-free debt, no interest, no payments for 7 years, you're not in a hurry to refi out of that debt. Will we carry that the full 7 years? I don't know if that's, going to be the case or not. At some point, we'll have so much equity in that deal that'll be really compelling to do a cash out refi on that deal. So every fund is a little bit different and every deal is a little bit different. And that's probably what that pattern will look like for Fund One in the coming years.
A couple different people asked about, once we do like our first distribution, right? So that's happening for Fund One. Will we do quarterly distributions after that, or will they be spotty? In general, our plan is to start quarterly distributions after that. That being said, our number one goal is the cash out refi.
Yes.
So we need to stay liquid enough so that the banks feel like we have the liquidity that we need to be safe and to, do all the underwriting and everything that they need for that cash out refi. So if at any point we think that the distributions might jeopardize or delay that cash out refi, we may choose to stop them, because that's our main target, right? That is goal one, and everything else after is far, less superior to that. Once we get to a cash out refi, at that point, you will have quarterly distributions, pretty much no matter what. They're consistent every quarter for the next 20 to 25 years. I call it kind of phase one until we get to a cash out refi. That's much more dependent on the fund, what's going on, what our banking partners want, how the assets are performing, how the renovations are going. with our sole goal for everyone to get to that cash out refi as quickly as possible, because that's when you have all of your capital back and you flip over to that infinite rate of return period. And that's when Nick and I start getting any profit whatsoever for, so we take no fees and no profit whatsoever. So it's, not untrue to say we've been working on Nicholas for 17 months now with no profit. And so we're laser focused on that day. And that's why the distributions might be a little lumpy in the beginning, but then very consistent after that first cash out refi. So I hope that makes sense. If not, ask questions and we're happy to do those.
Yeah, there's a question, how is revenue, expenses, and NOI compared to what we wanted to see for Fund One? Overall, we're right on track. I would say revenue is higher than we expected, but some expenses are higher than we expected. Renovation costs, labor costs have just gone through the roof. Insurance has gone up, tax has gone up. 100K increase just on the taxes for Nicholas alone. Many of our single family homes had very significant tax escalations. We've challenged some of those. So overall, we're right on target. In fact, I was preparing for this webinar and was surprised at how close we were in terms of, where we expected NOI to be and where NOI landed. We just got there, with a little bit higher income, a little bit higher expenses than we expected. But overall, I'd say we're, kind of right on track, right on, where we expected to be for Fund One.
Absolutely. A question came in about prepayment penalties on loans. Every loan's different, right? We have probably 150 loans at this point. We work really hard to minimize prepayment penalties.
We've never paid one ever.
Yep.
And we've done this a lot of times.
Yep. So we work hard, before we ever even close on that loan to have a good plan for prepayment penalties. And then if there is a prepayment penalty, almost every bank will waive it if you refi with that bank. So the prepayment penalties, as Nick said, they've never happened. Are they in our loan documents for many of our loans? Yes. Am I worried about them? 0%.
Yep.
Good question. All right, let's turn our attention to residents of Discovery Square. So we're closed. Very excited about that. This is split 50-50 between Fund One and Fund Two. We've gone over, some of the specs in our other quarterly reports. So we'll just focus on some of the highlights here. 129 unit building, commercial space all on the ground floor. That commercial space is completely vacant. The building was built in 2019. That's a big part of the reason that commercial space is still vacant, because COVID just really, kind of derailed this building. $27 million purchase price. We did a really, really, really favorable deal. That's why it took so long to get this closed. So we did a contract for deed. We put $3 million cash down, so a little over 10%, and then we assumed the fixed rate debt that's currently on the building. So just very excited about the really good debt that's on the building. The additional portion of the purchase price is a seller carry with no interest and no payment. So we've got a significant portion at 0%, a big portion at 2.83%. I thought it was 2.37%, but
so
we had a little bump with the
We
participating banks.
went back and forth with the banks forever, and finally we agreed on a 0.5 point bump on the interest rate.
Got it.
My 2.383 number might be off by a few basis points or something like that. We're still well
under
under
3 for sure.
Yep.
And then to acquire an asset of this size with only $3 million is really favorable for both Fund One and Fund Two.
Most funds would need to bring a $15 million down payment or $12 million down payment or something like that on an asset of this size in this condition.
Yep. So it was super exciting and a surprise for us. A couple of days after closing, it all went out in the paper, and we did not know this, that this was the largest multifamily real estate transaction in Minnesota so far in 2023. So that was pretty fun to see that in the media and to get to celebrate that.
Lots of buzz about it.
Yep.
Just some photos of RDS. It's a nice new Class A urban core asset. This is so I like Nicholas better. Nicholas is so handsome and timeless, but RDS is certainly, it's the most glitzy, glamorous. Its entire city block. It's the nicest asset we have in the portfolio. There's one of the clubhouses. It's got a full fitness center, a rooftop terrace. We're looking into retrofitting a all-season heated, irrigated AstroTurf pet park on the terrace. Like how can we crank this thing up, another notch in terms of luxury and amenities? So we love this asset. This is a really incredible asset. It's a privilege to own.
Absolutely. Want to talk about our transition?
So this is how the money's made is, we joke that transitioning these assets, it's like changing, passengers on an airliner mid-flight. We want to make sure we don't lose anyone. And there's lots of pieces of complexity with this asset. So this asset has a favorable tax package. In exchange for that, we have to keep 20% of the units at a 80% area median income or lower, and it has a student housing provider that's consuming many of the units to provide student housing, and that makes it eligible for that favorable tax status. But they have way more than that 20%. So I had this very, frank conversation with that student housing provider saying, hey, I know that you just brought some additional student housing online down the street. Would it help you if we unwound some of your units? Because they added a bunch of units last year, and just kind of just said, I'm probably, wanting some of these units back so we can take them back to market rate. You're actually probably wanting to give some of these units back to us you may not be able to fill. And they're just like, wow, we manage student housing with, 20 different, owners, building owners. And we thought it was going to take 15 meetings of hemming and hawing and poker and stuff to get to a place like this. Yeah. Do you want one back today? We actually had a unit that we got back the next day, which is going to have a huge kind of uplift on, our overall economic outcomes there. But we have, pretty much everyone transferred into our portal. We have about 30 units that we're going to turn over here in the next 60, 90 days. So it's which is what we wanted. Those are kind of the expectations we set with the outgoing management company. Don't push renewals because we expect that we'll be able to, escalate rents on those units, in some cases as much as 40%. Just there were low lease up rental rates for filling that vacant building the first time around. And we know that we're going to be able to really, get those up to market rates. So we would like those vacancies, but it's a tremendous amount of work to close on a building and a week later jump into leasing out those units. The other piece of the puzzle here is building out, loft townhomes in about 2/3 of that vacant commercial space. We acquired a vacant lot to the southwest of the building, and we also acquired a duplex property, a totally separate parallel transaction to the northwest of the property. Our goal is to install parking in both of those parcels, which is going to significantly enhance our tenant profile on the residential side and our ability to lease the commercial space for prospective commercial tenants if we have, kind of a luxurious amount of parking to offer. We've got bids from 3 builders to do a lot of this work, working on a 4th, having conversations with architects and engineers on a daily basis. This is a very involved project.
I really have to just pat you on the back a little bit that, even before we were closed, Nick was meeting with architects, designers, like just assuming that we would close, assuming the sale, we were under contract. Someone said, can I borrow the lamp that you rob that makes the bank allow you to take over 2.83% debt? You know what it is it's phone calls every single day.
Yeah.
It's not taking no for an answer. It's seeking to understand people's needs, finding win-win solutions, finding something creative. And just showing up with a sense of confidence that, this is going to happen. How do we make this happen? Not, is this going to happen? And I just was so proud of you that, for the benefit of our investors, you were working on a deal. You're working on building out a deal that we don't even own, because that speeds up the timeline.
People are saying no to me every day. It probably took a couple hundred no's that I had to get through to get this to the closing table.
Yeah.
And just manifest what that future reality will be. I know at some point the architect, the engineer, the builders were like maybe calling the current owner saying, hey, yeah, we're working on Nick's build out here. And the seller's like, am I selling that building? I don't know if we're actually agreed on everything here. And eventually it comes to be. So just project a bold vision confidently. Don't take no for an answer, and you can make anything happen. This is definitely, for everything I can see, this will be the best that we've ever done in our real estate career. And it's just such an incredible, not a lot of quote unquote small operators own buildings like this. This is just a really exceptional building to own for, even with a 1/3 of a billion assets under management, we're a relatively small private equity fund. And I'm really excited that we get to call this thing ours and yours.
Absolutely. So excited. You see, if you were looking at your screen there, you saw I kind of flashed through the renderings and everything for our build outs. I was actually just looking at the calendar too. It is extraordinarily likely that we will have many of these units to show for our September meeting.
We'll have some fun job sites.
Yeah. So our timeline here is internally we're saying 6 months. Realistically, it'll probably take 9 months to get all of them built. That's just how construction works. But it's very likely that we would have. It's very likely that we'll have something to show in September. So super excited about RDS, and we're gonna have a lot of updates to come on that. Let's turn our attention to Fund 2. A question came up. I'll address it here about this particular investor asked about any updates on Garden Court. So many of you might be wondering, like, well, what is Garden Court? So prior to our private equity funds, we have a whole host of joint ventures, and we've typically not done these public webinars for those joint ventures because they're very small investment groups. It might be us and one other person, or us and 6 or 7 other people. We actually just decided a couple of days ago, that's why we weren't able to do it for this quarter, but we are going to start including the updates on those projects in these webinars. Number one, so that those investors get the updates that they want. But it's actually like the most important part of our portfolio because it's the oldest. So it shows you the properties that we've completed cash out refis on. It shows you the properties that we're actively working on cash out refis. Like one of those joint ventures, we had the appraiser in there just last week, and we're submitting, all of our financials and everything. So all of you will be very interested in that, because that, even though they're joint ventures and the private equity fund is a private equity fund, everything else is exactly the same. The structure, basically we took an operating agreement and just created a PPM with that so that it would be a private equity fund.
So we don't have any slides, but I just pulled up my notes here. And right now we have about 25 renovations on. These notes are from 2 months ago or 45 days ago. So we've probably gotten a little bit further along, but at that time we had 25 rehabs completely done out of 64 units. We had 2 that were actively in renovation. Our goal is to be doing about 3 units per month, which will be, a 50% acceleration from our current pace. And our goal is to kind of like our big refi when we get to about 50 rehab units, so somewhere in the 50s and it's a fine line to walk for any of the projects and any of the funds when we're doing deep value add, because as soon as we do that cash out refi, that lowers our renovation velocity. And we want to, there's a sweet spot. So you probably are able to get a full cash out refi before you renovate every unit. Every building is just a little bit different. And each unit that we renovate, produces more NOI that gives us kind of more financial breathing room to do more units at a time. So let's say we did a cash out refi at 30 units, like right now, we might only have enough, financial breathing room to do like 1 rehab at a time. And then we have projects like Nicholas where they only needed light rehabs, like 1/100th of the renovations for Garden Court West. We could do 40 of those at a time. So every project's a little bit different, but that's our update on Garden Court West for you.
Absolutely. All right, now we'll jump in to Fund 2, and next quarter we will have a proper, we're going to call it our legacy projects.
Something like that, yeah.
Okay, so Fund 2, the big excitement for Fund 2 is that all of the acquisitions are complete. So we now all know, all of our investors in Fund 2, we all know exactly the assets that are going into Fund 2. So that's really exciting. So we have Tanara, Residences of Old City Hall, Hamptons, Douglas, Riverview, Garfield, Colby, RDS, Kensington, and Lauriston. So a really impressive lineup of multifamily assets, some here in Rochester, some in Tacoma. You might be asking yourself, are there single family homes? And we still love single family homes. I don't want to, at all give the impression that we've graduated from single family homes or any of that nonsense. Pricing just doesn't make sense for single family homes right now, whereas pricing does make sense for multifamily. So this particular fund isn't getting a portfolio of single family homes because the numbers just aren't there right now, whereas they were in Fund 1. And
when interest rates went up, pricing went down instantly on multifamily, which is when we launched Fund 2 and why we launched Fund 2. Even though we hadn't deployed all the capital for Fund 1, we knew there was a coming opportunity to deploy a huge amount of capital. There were going to be a lot of opportunities in the multifamily space. On the single family side, 40% of US mortgages are below a 3% interest rate. So even though rates are up, prices are not down because no one is selling. Why would anyone sell a single family home at our personal homes at a 2.5% interest rate? We're staying there for a very long time. We'd have to double, triple the price, cut the price of our next home in half or a third, to get the same amount of, house for the same monthly payment. We'd rather just stay where we're at than make a change like that. So there's been really low inventory, have not seen prices coming down in our area at all. And that's going to be the case in a lot of markets as well.
Yep. All right. So renovations. I think I said in the last webinar, it was the first time I kind of just declared it, that renovations are the most important part of our business, because renovations is where the value add comes from, which generates the cash out refi, which gets us into the infinite rate of return period, which allows that wealth creation in the portfolio to grow. So for our renovations,
this is just in Rochester.
That's right. Yep, just in Rochester. 103 renovations since January 1st. Right.
We're like 11 months into the year, right?
No, we are. And this was only until March 31st. It's way more than that by now.
First quarter, we did 100 rehabs.
Yep. Yeah. We have 51 job sites that are active right now today. At Douglas Trail, that's a 100 unit townhome community. We have renovated 35 units. We closed on that in October or November. So we've had it, let's say 6 or 7 months. We're a third of the way through our renovation there. 17 are actively under renovation right now. Riverview, we closed in like October or November. It's a 63 unit building. 20 units are complete, and we have 10 more that we are targeting for June 1st so that we can get those leased by July 1st or at latest August 1st, right in the peak of the leasing high season.
That one should be done within the scope of the season. That'll be very exciting.
Yeah, so that will be a full renovation of a full apartment building.
That'll be the first one to cross the finish line
in probably, let's say 9 months.
Something like that.
At most a year if we have kind of some stragglers. But
that was all or almost all short-term tenants in place, so it was easy for us to turn over those units quickly.
Yep, as soon as the Airbnb reservations were done, we just canceled all of those and started our renovations. We didn't cancel on anyone. We didn't add any new bookings there. I always want to be clear to show that we think a lot about not disrupting people's lives, whether it's a vacation they have planned or coming to Rochester for treatment or a lease or whatever. We're always very sensitive to work around people's lives.
Slower than we probably could or have to or however you want to think about that. But we have just conversations with tenants and, hey, are you excited about these renovations? Okay, awesome. Let's get you into our first, renovated unit, and you can be kind of the block captain and get other people excited. Is this something that you're fearful about and nervous about? Well, what? Let's make yours kind of the last unit we renovate, and just make sure you have an infinite amount of opportunity anytime between now and when we get to that last unit. You can vacate, get a prorated rent refund, get a full refund of your security deposit because we're gonna do a gut remodel on the unit anyway. Whatever we can do to minimize your impact, and maybe the outcome is we go a little slower than we have to, but the outcome I think is the best outcome for everyone involved.
Absolutely. You want to talk about our construction manager? That's your win to share.
Oh yeah. So we hired, the individual who had done that beautiful renovation. There's a photo of one of our single family homes. He's been working for us for years. So we hired that individual and then 2 individuals that had previously worked for that person, kind of folded them into our operations as full-time W-2 employees. So he'll be doing site supervision work at residences at Discovery Square. We're growing our workforce in a big way. I think we just hit 40 employees now. We're bringing lawn and snow in house. Our cleaning team is just absolutely crushing it. They're working all weekend here because we had the first month at a weekend here this past month. And when we had vended cleaners in years past, it was just a nightmare trying to get all these units turned over to our quality standard. When it was on a weekend like that with our in-house people, we're getting those quality standards that we really want to get. So I'm excited about what this is going to mean to have this new construction manager persona in-house. And we're just going to continue to hire the highest quality people we possibly can. We're going to keep getting incredible outcomes.
Absolutely. All right. Tanara is really the cornerstone of Fund 2, really Tanara and RDS, because they're similar asset value size. So the value today, we project it might be around 28 million. It's 130 units. We are working really hard on our renovation there. Our target is at least 36 million, about 24 months after we acquired it. So we're a little less than a year into our ownership. This was a 1970s build. It really hadn't received much attention since probably the early 90s. And so it wasn't, distressed, so to speak, but certainly was not very nice. And very excited about our renovations that are happening there. We were just there, 4 weeks ago or 6 weeks ago? Don't ever quote me on time. Time just moves too quickly. We're going back to Tacoma at the end of June to check on our projects again. So you can see us there looking at our new kitchens, all new cabinets.
In the top right photo, and then I think that's Elaine looking at the landscape architecture plans with Daniel, our kind of a captain of the ship there in Tacoma.
Yep.
We are in the thick of things. We decided to just go all in on rehab. So we have 26 units being actually renovated, getting held up on permits and stuff because our renovations are so big. We have to pull a ton of permits. That's been a headwind or a point of frustration, but we're just all in on renovations there, doing common areas, clubhouse. So I really like this photo on the left is kind of our before, on the right is our after. We went from some kind of yucky, appliances and finishes and, laminate counters.
This is actually our modest after. So in a few of the units, we just painted the cabinets so that we could get them leased and kind of focus on our bigger renovations. the extreme majority, I think we only painted 2
Yeah.
or 3 units. The extreme majority of our kitchens are getting brand new cabinets that you can see there.
Two-tone. Yeah,
Mhm.
it looks incredible.
Yep, you can see the stone countertops, the new faucet, the really great appliances. We're experimenting with different things. You can kind of see a little edge of it
bar
there.
there, yeah.
Yeah, like a little breakfast bar, because the units are a little bit smaller and there's not, you can see in the left-hand picture, there's not like great space for like a full dining table, but people, likely want a place to eat outside of their, couch in their living room. So we've tried several different configurations. We haven't landed on anything that we're just like absolutely in love with, but every unit has kind of a different seating place where people can eat as like a kind of a built-in dining space.
Yep.
Here's the plan for our landscape architecture. This is like the big project
Yeah.
at Sonara. So in addition to all of the common area improvements and all of the units, the exterior living space is really what's going to just completely change the feel of this community, really bring it up to modern standards, take it from that C-class community to an A-. In the center of the buildings, there's about a 1 acre lawn that's just grass. That's just been, it's been a nice lawn for the last 50 years, but nothing exciting. There were like some old lawn chairs on it, and people just weren't really using it. If anything, it was just a weight on the community because of the expense of mowing it. And we're, completely changing all of that. So we're putting in a pickleball court and several different dog parks and several outdoor kitchens with great seating areas, and, working with the architect so that, different seating areas have different shade, so that if it's, if you're having kind of a 1 p.m. picnic, you would go to this particular seating area, but if it's more of an evening thing, you might go to this other one that gets a little more sun in the evening. Just really, really excited about this. This is, we are in the throes of this work right now. We will have more updates on this when we go to Tacoma at the end of June.
Yeah. Douglas Trail, I said RDS is going to be like our most successful, like best deal ever, but Douglas Trail is.
I chuckled when you said that, because
Yeah.
It's like which child do you love the most?
Right,
You
right.
love all of our deals.
Yeah. I mean, the fact of the matter is, it's, Class A deals, it's harder to generate yield on Class A deals. There's people are just willing to pay more for them. And Douglas Trail was not a Class A deal when we bought it, but man, oh man, is it just the ground this thing is covered. About 50% of the units were in rent collections when we bought it, and that's allowed us to really have the pedal to the metal on renovations. We went to these tenants who were, $3,000-$6,000 behind on rent, and just say, listen, we'll wipe the slate clean. We'll forgive all this unpaid debt. You can just vacate, and we'll give you, whatever we can give you on your way out the door. But usually we need to go really slow here. In this case, when there's so much rent delinquency, we just said, let's wipe the slate clean, and that's allowed us to vacate a lot of units in short order and renovate them. I mean, the renovations on this place, you drive through the neighborhood because it's like a 15-acre campus. There's just work trucks everywhere. We've got 17 rehabs in process, 35 complete. It's 100 townhomes. So it's not an apartment building. It's a townhome subdivision. So when you drive through this community right now, it's difficult to just, the amount of work that's happening all at once in this community is staggering. We have about half of the units in flight. So, we talked about how it's like, changing passengers mid-flight. We have about half of those passengers, half of those units are in transition all at the same time. So it's just a staggering amount of work to juggle all those things for our leasing team, our operations team, our innovations team. But we're going to do like a 180-degree turnaround on this community in 9 months. I mean, it's just with the amount of improvement we're able to make.
We're just having baby after baby after baby.
Yeah. And significantly improving rental rates. This is my favorite slide from the
I just noticed you're in a suit.
That's because I just picked up my suit for my birthday party.
Oh, wow.
I wore it out. I was so pressed for time. I mean, I'm just always so pressed for time. I couldn't be bothered to like change back into my street clothes. So I went straight.
So tell people the story behind this crazy picture.
So when we bought this place, 100 townhomes, they all had 2 canisters, 2 trash canisters. One is like green with a red top. The other is like pink with a blue top. So there's like, as you're driving and the wind blows and they fall over, and on trash pickup day, they're all sitting at the curb. And so as you drive through this beautiful community with amazing green spaces, all you see is a menagerie of trash cans, of dumpsters. So we just, when we got to springtime, it was difficult to make this change during winter time because there's, snow and ice everywhere. When we got to springtime, we went and collected all those trash canisters and put out, dumpsters. this had the canisters had an additional problem that they were small canisters, so you couldn't fit bulky things in there. And the property management company, the previous property management company, had done nothing to provide for bulky disposal for the tenants. So as we were touring the units, probably 75% of the units, their garage was full of waste of couches and mattresses and stuff. So we now have a place for people to dispose of that waste. We have like, I don't know, like 10 dumpsters at the properties. We're turning over these units, just giving people the facilities they need to dispose of the waste. And when we're all stabilized, this will cut our trash bill in half. So not only are we actually providing adequate trash facilities to the tenants, but it also cuts our costs in half, which is massive on a cap rate basis. So the team was like, Nick, the trash cans are gone, the dumpsters had arrived, and I had to drive out and see with my own eyes what this place looked like without trash cans everywhere. And so this was I was just so elated. I looked inside, like, oh, there's trash in there. It's so awesome.
You're so funny.
Yeah.
We drive our family through this community about every Sunday. It's maybe 4 miles from our personal home, and our children are 7, 5, 3, and 1. Our 5-year-old and our 7-year-old, the first Sunday we drove through, we didn't say anything. We just kind of almost sort of like a little experiment. And we were no more than, 3 seconds into the neighborhood, and they're like, where are all the trash cans? It's a big difference. It's a big difference in quality of life and just the feel that you have when you drive to your home at the end of the day, or you're leaving your home first thing in the morning. You want to look at a nice lawn and a nice place to live. You don't want to look at a bunch of different trash cans. I also chuckle because in the background there is one of our construction trailers.
So literally there's a dumpster next to a dumpster next to a dumpster. And that's just what, when you got 50 units in flight, that's what it takes.
All right, Riverview. So go ahead.
Yeah, just in the interest of time, just kind of blast through here. This is going really fast, really fast. We had some favorable terms when we bought it. We're doing huge renovations there. So this is a condominium complex. We got control of the HOA when we bought it, and a bunch of additional units. We now own, I believe, 45 of the 63 units. So we've been able to acquire a ton of additional units since we bought it. Eventually, all the units will be owned by Fund 2. 20 of those 45 units have already been renovated, and then 5 units are ready to be leased, and 8 are under active renovation. And there are some where we allow those tenants to stay in place, just got a lease agreement in place. So there's a few other units there to kind of pick up the difference. But just a few photos, like this place just looks like $1 million. New flooring, new paint, new appliances. There was a pretty extreme pest infestation issue when we took over it. Our staff was not willing to enter the units. Our staff is pretty
pretty folks.
Yeah. And they're like, Nick, I don't think we can have our people in here. I'm like, well, what do you mean? They're like, well, I think we could have infestation problems that spread to other units, other buildings. I'm like, come on, let's get some grit. And I walked in, I'm like, we need to get some people in hazmat suits out here. This is, is pretty extreme, as we, vacated the possessions and stuff there. And just this place looks incredible. Brand new fitness center, all new exterior landscaping, all new paint in the common areas, tons of new flooring, new lighting. There was a new sign. There was this really ugly shed in the back of the building that was just kind of a dumping ground for weird waste, and we ripped that out. And I think someone actually maybe took the shed away. I don't know. Just a huge turnaround at this community. We're really excited with the velocity we've been able to achieve on Riverview.
Absolutely. And it is leasing extraordinarily well. Lots of nurses really want this one because it's very close to Mayo. The unit size is a little bit larger, lots of natural light. So it's leasing very well over the last several weeks. Residences of Old City Hall. We're doing really well with that one. There's the acquisition details there. We've talked about those in previous webinars, or you can read the screen there. Exceeding our pro forma handsomely by at least $300 per month per unit. That doesn't that doesn't include the leases that we're signing for like June 1st and onward. 13 of the 22 units have been complete. 1 is currently in process. And then there are a good handful of residents living in this building that have been there for 5, 7, 10 years that would like to stay. So those other 9 units will work with those folks to say, do you want to stay in the unit that you're currently in? Do you want us to renovate it while you're in place? That's not our first option, but we are willing to do it. Or do you want to move, down the hall to a renovated unit? But the people that are there love this building and want to stay. They know that there's no other living space like this in Rochester. I mean, really in most parts of the country. You live in a a 1920s Art Deco, just beautiful grand building. So very excited about that. You can see some of the photos there of there's 3 units that were previously the city council chambers. So this is one of them. They're kind of the crown jewel units of this building, and really of our entire portfolio. We don't have other units in our portfolio that have, I call these windows 10 feet. I think they're actually like 15 feet. I'm not sure how tall they are. I know that one of our facilities supervisors was standing on this ledge, and she's a 5'3" woman, and her head was slightly above the first line. So I think these are probably 15 feet windows, 30-foot ceilings, just really beautiful. And those of you that follow us on social media and know of the open house that we had. So this is technically a Q2 update, but it just happened on Friday. We had to share it. We really believe that even though this is a privately owned building, it is, part of the public good. It really belongs to the city of Rochester. And so we did an open house. 500 people attended. We were kind of not sure how it would go. Yeah. We're like, maybe we'll get 20 people. I don't know. It was just a blast. People in the community were excited to be there. I mean, people would just walk up to us and say, I have wanted to be in this building for 10 years, or I haven't seen inside of this building for 35 years since when I came here for my driver's license, or, to go to the city clerk for my marriage license, or just whatever. It was just a really sweet, really special time. All over the local news. It's kind of like our favorite thing about living in a small town is the paper will come, the news will come, those sorts of things.
These are all articles, by the way, on the wall behind us from our local newspaper. We're always trying to do whatever we do to contribute to the community in the paper. Paper, let's talk about it.
Yep. Rachel put together this event. So, massive props to Rachel. She just has an eye for our brand and for serving the community. She went to you can see these kind of banners here. She went to the History Center and got like all of the newspaper articles that have ever been written about City Hall and kind of pulled out the most important milestones of the community. And then those are now, just a permanent part. So people that live there can see that history. People that are touring that building to consider living there will be able to see that history. She just did a really nice job. Just very grateful to Rachel for pulling that event off.
Campus. This is another one of these boring assets. We bought it for just 1.5 million. It's probably worth at least 1.7 million now. We've done a really good job aggressively renovating it, had a seller carry. This is just a solid base hit. The more of these base hits we can kind of rack up, the better. We can go to the next slide on renovations there. 5 renovations are complete, 6 are in progress right now. So a huge amount of renovations happening. We're almost done with this project. We were hoping to turn over these units a little bit faster, but the in-place tenants it wasn't the time for those in-place tenants. We actually I don't want to get into deep in the weeds, but we helped the tenants buy a new apartment building, and they are relocating into that apartment building. It's a crazy, awesome win-win kind of deal that we were able to put together. And we're unbelievably excited with our outcomes. These renovations look incredible, and we've had really strong leasing performance on our renovated units on this building.
Our facilities team did a whole day of going out and picking up cigarette butts and glass pieces. I mean, this was probably the most scary community we had ever acquired. There was no physical insecurity, like no safety concerns, but certainly a feeling of safety concerns because of just trash and stuff kind of all over the community, and all of that's gone. So as soon as the snow melted and our people could be out there, it's clean. We have our landscapers out there. Spring has sprung in Rochester, and so the green is coming in. The renovations are happening. Just really pleased of taking this community from a drag on the overall community to a great place where people can live. And a 12 townhome community really appeals to a lot of people because it has a very small like little community feel. It's very different than living in, say, a 100 townhome community. So very excited about the transition that has happened at
many of these residents were recovering from like alcohol abuse and drug addiction, and they had kind of like a captain that was kind of keeping everything together. And we theoretically could have asked all these people to leave. We didn't think that was the right thing to do, and they now own an apartment building that's dedicated. That's now like a drug rehab, alcohol rehab facility in Rochester, and we're just.
All the credit for that goes to Riley. Many of you know Riley or heard of Riley, our director of growth. He put together all of those deals, really served those people in a way that we're really proud of.
Theoretically, I don't know, lowers returns a little bit or something to give these people the time and space they need to stay together. But this is some of the proudest work we've done. So,
absolutely. Garfield.
Whew. So, fun mixed use project, just a really cool historic, building, a C-class building that we're going to renovate into a B-class. It's on the campus of Pacific Lutheran University, which is a very premium private university. You can see in that corner, lower right corner photo there's a brand new Class A, knockdown development across the street. Just insane upside potential on this particular property. We're digging in. This is definitely a Class D building when we bought it. So lots of challenging tenants in place on board, many people with no computer, no smartphone, no way to, get onboarded into our portal, which is Buildium. There's a lot of meters in the property because there's all these commercial tenants, all these residential tenants. We were walking the property with Daniel, and we're like, okay, so we see like 7 meters here and like 13 meters here and 5 meters here, like which meter goes to which. This is how crazy most utility companies don't actually know necessarily which billing accounts go to which meters. And we have properties in Rochester where we'll have the property for years and then find out like utility company has been billing the wrong meter to the wrong account or whatever. Just the previous owner, it was all just kind of like master meter, just kind of, and that meter situation is the epitome of the property. It just is a lot of work, an exceptional amount of work, kind of untangling that mess and getting it into a place where it can really be professionally managed. There were some undesirable commercial tenants that we vacated. There was a kind of permanent food truck, with like a flat tire, that sort of thing. They're gone. That was an easy one to vacate since they were mobile in nature.
Sort of.
A secondhand computer shop that was really kind of like a hoarder's paradise, and that doesn't exactly look good through your retail glass there. And we'll call it an apothecary store that has also been vacated. There's lots of great tenants. There's a Cabaret Coffee. We got lunch there while we were in Tacoma a few weeks
It
ago.
was really good.
It was fantastic. It was,
So this building is right where students from Pacific Lutheran University are walking every day. And, kind of like Hamptons, like right now it's a place that it's not, well, when we acquired it, we've had it for about 6 months now, but when we acquired it, it wasn't unsafe, but it kind of gave you that feeling of like, I'm going to walk fast when I go past Garfield.
Yeah.
And we want it to be student housing. We want it to be a place where students want to live. And many students are moving in this summer within the renovated units. And then we want those commercial bays to be places that appeal to students, that's the demographic that's walking past every day. What do those people want? They want a place to get a sandwich. They want a place to get a coffee. They want a place to get hair or something done. So just making that community match the demographic that it's serving, that are walking past it every single day.
Yep. So we've turned over 3 units, renovated a couple of those. One's in progress right now. We've had, I'm going to say, shockingly high rents that have been kind of trivial to achieve on our turnover so far because we're now marketing to a student tenant demographic. And, we're going to really bring this building to highest and best use, which is basically on-campus housing for students, which is an unfair game. We're going to be able to get really premium rents for this building, and it's already in light years better shape than it was when we bought it, but it's going to get just so much better still. And this is that rare situation where, we bought the least nice house in the block, but we actually got like 2 commercial centers and apartments. And like, we're going to be able to just totally change this whole area by lifting up this whole thing. So it's going to be incredible.
Let's talk about Colby. So we've kind of gently rebranded this to the Colby.
The Colby.
This is acquired by Fund 2, $2.65 million purchase price. This was like, we heard about it. We were closed. We paid all cash for this. We'll talk about that in a little bit. I think we were closed in like less than 30 days. We didn't do a deal webinar. We were just moving so quickly on this one. So this is really kind of the unveiling of Colby. So take it away.
They had gotten multiple offers. Ours was the lowest offer at asking price, but ours was all cash, no contingencies. We worked with this broker before, and he knew that we were the kind of people who close. This is a Class D property that really needed a lot of love and might struggle to conform for a loan. So that all cash purchase was massive value we could offer. And this is just exceptionally valuable dirt, Class A plus location. We got a 32 unit apartment building, 2 single family homes, and 2 vacant lots, all physically adjacent to one another. We could easily put $100 million building on this piece of land at some point in the future. We're not gonna do that right now. Right now, what we're doing is we're doing light value adds, fixing a lot of basic things. There's roof leaks that we're remediating. There's just some basic things that we're fixing to get.
I mean, we are at like life safety issues.
Yes.
Like there's no water coming into units. Everyone has hot water. Everyone has a door that locks.
Ceiling, and so This is just a unit or a building that needed a lot of TLC, and we're just pouring that TLC and doing some light renovations, knowing that at some point in the future, we will knock it down. So we don't want to go crazy, but we just want to get the units stable and get the property stable. And then we'll be able to get really favorable financing, maybe even a full cash out refi. I don't know. It's really cool having a private equity fund where you can go buy
I'm sorry.
not just an apartment building, but apartment building, a couple of houses and some land, all cash, no contingencies. This is what we used to do with single family homes.
Mhm.
This is the first time we've done it with an apartment building. And man, oh man, is it cool.
Mhm.
So really excited about this. There's a slide, I think if we go back one, yeah. So the green box here on the right is the Mayo Clinic St. Mary's campus. The red box is Colby Manor. So those are the 4 parcels that we got. And then the yellow box is the Berkman. So this was the largest real estate transaction, single building, multifamily transaction in Minnesota history. This
Mhm.
is a hundreds of millions of dollars building that transacted a year ago. And it's right next to that St. Mary's campus location. So our location is not as good because we're kind of across the highway, but there's a pedestrian kind of sidewalk on that car bridge, and it's extraordinarily walkable. Just the
Mhm.
northwest is Cascade Shores, Cascade Lake Park. This is just a ridiculously good location, and the zoning allows us to go up 100 feet with no limit on unit density. So there's floor area ratio restrictions and stuff, but we could put a huge number of units in this site at some point in the future.
Absolutely. Do you want to just speak, just because this is kind of our unveiling of Colby, about sort of what this might mean for Fund 2?
Yeah. So
So this is far in the future. This is like 5-7 years in the future.
Yep. So at some point in the future, we could potentially sell this land out of Fund 2 into a future fund that would do the development. An ideal world for me would be one where Fund 2 stayed in the game as an equity partner. So that's how we have structured land development or redevelopment plays in the past, where we take the existing owner and pull them in as an equity partner. So it just kind of depends. There's some implications to each of those kind of options, but there's no way that the Fund 2 investors are going to be sad, about the outcome, whatever the path is. But those are the 2 most likely options there, and we'll just have to kind of look at what's necessary. But we'll need to do like $30 million of capital raise potentially to do that redevelopment effort. We're not going to go do a $30 million capital call from Fund 2. We'd launch a whole new fund just for that redevelopment effort.
Absolutely. If you have questions, let us know on that one.
Yep.
There's our transition, Kensington and
Gosh, I
Lauriston.
keep thinking we're at like the last building.
No,
These
these
been a
funds,
busy quarter.
these funds are big, and it's been a busy quarter. A hair over $8 million purchase price, 2 Class C buildings in just a Class A plus area. We'll do a construction loan for our renovations there. It's about a mile from Tanara, but it's really in a completely different world because it's in downtown Tacoma, in an area that's undergoing massive transition. We toured a brand new construction building, like just 50 feet away from Kensington and Lauriston while we were there. The current rent roll is at $765, and our pro forma for 3 years after renovation is about $1.3 million. So about doubling the rents, more or less. We've proven that at Garden Court. We are proving that at Tanara and our other communities in Tacoma. So just like you're seeing in our Rochester portfolio, like every deal is a little bit different, right? They're kind of like brothers and sisters or cousins, but to some extent you're hearing like the same story over and over and over.
Class C, Class D, and Class A plus location.
Yep.
That we paid $2.65 million for Colby Manor, and we're a couple blocks away from a $200 million building. Kensington and Lauriston is across the street from Caesars, which is a brand new urban infill construction project in Tacoma. $400,000 per unit is the total development cost on Caesars, and we're paying, what is that, like less than 100, or it's more than 100K units, like 120K unit. It's fractions of our neighbor, and those are the times when you're positioned for incredible long-term upside potential.
Absolutely. So kind of the summary for Fund 2 is, as we sit today, we have a total asset value of a hair over 80 million, 80 and a half million. you for Fund 2. And we still have about 2.1 million of liquid reserves. That is for our continued renovations at all of the buildings that we just talked about, Kensington and Lauriston acquisition, our build out at RDS. So that's where that capital is being allocated to. So we're at a place where there will be no new additional acquisitions into Fund 2. We have, kind of all of that capital has been spoken for with our renovations. And it's, it's really our estimation that within, say, 3, maybe 4 years, the value of Fund 2 will be at least 100 million. So
It's incredible.
very excited about that, to produce that in a short period of time, but then to deliver an infinite rate of return against a $100 million portfolio. Like, an infinite rate of return is great, but I always joke, like, well, if your infinite rate of return is a penny, like, it's not it's still an infinite rate of return, but it's not life changing. An infinite rate of return against a very large portfolio. Now, that's a life changing quarterly distribution that's coming in, and in year 10, 15, whenever we're able to do subsequent cash out refis, those will be very handsome distributions. And so just, Fund 1 is really seasoning, Fund 2 is seasoning, and just so proud of both of those funds and excited about that. We have a couple property management updates. We'll kind of blast through these because at this point you've heard everything related to the fund performance and investment performance. These are just kind of the things that keep us busy. So Black Swan Living, we're big on vertical integration. So we're bringing lawn care, landscaping, and snow removal in-house. These are areas that are huge cost centers for us, and we just never quite have the quality that we want.
Very frustrating.
Yep. And just so high cost, low quality, spending a lot of time working with third-party vendors. So we're just bringing it in-house. We've done it with maintenance. We've done it with cleaning. We're excited to do it with lawn and snow. It's a huge lift. It's hundreds of thousands of dollars of equipment that we shoulder. That doesn't come out of the funds or anything like that. We shoulder those costs so that we can provide that service to our buildings to increase the quality so that our residents are happy. For snow, to decrease our liability, right? So that we know that snow clearance is happening at the level that we're comfortable with, to make sure there's no slip and falls, and then to lower the cost so that we can drive up the NOI to, because that's based on a multiple at cap rate. And then, that gets us to our cash out refi. 103 renovations completed since January 1.
It's crazy.
1,821 maintenance tickets closed. It's just a staggering. Yeah, Tyler is our construction manager. Sawyer works right alongside him. Lots of maintenance people on our team. We're adding, new maintenance people. Really proud of the work that they're doing in not only maintaining our properties really well, but getting to these tickets very quickly, providing excellent customer service and communication with our people. Very excited about that. Our leasing team put up 122 leases in Q1, which isn't, a huge number, but that is by far the slowest quarter of the year. So I'm excited to see, what that number will be.
We might do that in a month, in the coming month.
Yeah, absolutely. We took our team boxing. That was super fun.
No injuries.
No, and we had the whole boxing studio reserved for our team one afternoon. They whooped our butts. Yeah. It was intense. We send out a move-in customer service satisfaction survey to our residents, and our current score is 8.7. So we're very excited about that. I'll be hopelessly transparent. Years ago, we were at like a 7.5. We were using third-party cleaners, third-party maintenance. Yep. And, just like all the drawers weren't cleaned on the inside, or
in the peak of the high season, it would dip down to like 6.
Oh, yeah. Yeah.
I mean, most property management companies, they don't even know what CSAT is. That's just the brutal fact of our industry.
That stands for customer satisfaction.
Yeah. On a scale of 1 to 10, how happy are you? And if we didn't get a 10, what can we do to earn a 10? And these scores have been creeping up as we bring more maintenance and cleaning and other functions in-house. And our cleanliness CSAT used to be our lowest score. So like property condition, 10 out of 10. Customer service, from our leasing staff, operations staff was almost always a 10 out of 10. And then cleanliness would be like a 4 out of 10 or a 2 out of 10. It's like, gosh, we paid, $300, $400 to a third-party cleaner to clean this unit. And somehow we're still at a 2 out of 10. Like, how can we solve this problem? And eventually we just had to bring it in-house. We just had to hire really, frankly, overqualified people to go clean for us. People coming from a hospitality background with much higher level of, higher standard for cleanliness. And so that cleanliness CSAT score, that is just, I'm so unbelievably proud of
That's
that.
Brianna, our
Brianna.
facilities
She's
director.
incredible.
Yeah.
Absolutely incredible.
And then Rachel did an annual survey to everyone. So we do a move-in survey, but once a year we're rolling out an annual survey. We got 85 responses this year with an average of 8.4. And that's kind of holistic of how was your move-in experience? How has your maintenance experience been? How has your overall living experience been? How has it been interacting with our team? So we're very excited about that. We're proud of that number for our first round, and then excited to dig in so that next year when we send out that annual survey, we're at least an 8.5 or higher.
Yeah, we mentioned a 78% renewal rate at Nicholas. Industry standard would be maybe a 60% renewal rate. And that's, you can drive a truck through that margin there, that we only have to place, 22 new leases instead of, 40 new leases. The wear and tear and turnover and vacancy and leasing expenses and stuff it's just incredible. And when you just make people happy, they don't want to leave. It's really that simple.
Lots of conferences per usual. We try to be out and about, networking with our colleagues, meeting all of you, learning from the best of the best. So some of these were in Q1, and we talked about them in our last update. Some of the new ones, Nick went to Best Ever Conference, had an opportunity to meet one of our coaches, Trevor McGregor. Nick went to New York City, and there's a lot of confidential information there, but let's say he had the opportunity to spend a few days with the asset manager and some of the property management staff of a portfolio of $30 billion, including the World Trade Center, Times Square, many, names that we all know. Just honored to even be invited into that room, and just excited to learn from them of what does the game look like at this level. And if you're managing, one of the most prestigious assets in the country, in the world, like what
the most prestigious asset in the Western Hemisphere.
Is that the line?
Yeah.
Like, what can we learn? How can we manage our single family homes in the Midwest with the same quality standards? So just so excited about that. We will be at Multifamily Investor Nation Con in Charlotte, North Carolina, June 12th, 13th, 14th. We're then going to zip over to Phoenix for the Limitless Conference, June 15th, 16th, and 17th. Nick and I will be on stage at both of those conferences. We'll have a sponsor booth as well. Rachel, Stephanie, some of our other folks will be there. So if you're in that area or you're considering, your own conference schedule this summer, I highly recommend both of those as really great real estate and financial education conferences. I think we have some various discounts and things that we're able to offer. Rachel has put those in the chat. I'll be in Austin next week for our meetup there, and I'm spending some time with Gary Keller. So just staying busy. When we're not busy in Rochester or Tacoma, we're either busy with the kids or out and about in the country.
It's been an exceptionally busy first quarter.
We have no fees. We've talked about that a million times. If you have any questions about that, let us know. The tech fund.
Oh yeah, we have another private equity.
The tech fund. It's doing really well. I had a call with Christian yesterday, have some updates to share. It is a little bit different than our real estate fund. We've talked about that in some of our other Q1 updates and in like our tech fund launch. So if you're curious about that, either ask questions of Rachel, myself, book a time with Nick or I, or listen to some of those historic presentations. In the interest of time, I'm just going to focus on our updates. So some of the things that are important to know are, since our last update, the big hubbub with Silicon Valley Bank happened. And Lotus was not at all impacted by that. One of our underlying companies had, I think, like 300,000 there. All of that money is there, that nothing has been lost. What's most important to know is that Lotus has no debt. So unlike real estate, where we really believe that real estate is half the deal, half the debt, and that together they're magic. And you'll notice in our presentations, we're talking a lot about what bank has that debt, what are the terms, what's the interest rate, how much longer is on the loan. We don't have any debt in Lotus. And the reason for that is technology companies are just so much more volatile than real estate. Real estate's pretty consistent. You collect some rents, you pay some maintenance tickets, you pay some property taxes, you're good. You can use, the vast majority of the rest of that cash to pay your debt. It's not necessarily so in technology. And so Lotus is really positioned to be really conservative. We're not at all impacted by anything that's happening, in the tech world around, bank fears or those sorts of things. Our K1s will go out in June. I apologize to our investors for that timeline. Basically, what has to happen is the underlying companies have to create their K1s. They have to then submit their K1s to Lotus. Lotus has to get their K1s out to all of their investors. Then they get the K1 to me. I get it to our tax team, and then I send out our K1. So that's why there's a bit of a delay there.
There's three layers versus kind of like one layer, so to speak, with the real estate fund.
Yep. It's something we've talked with Lotus about. Last year, their K1s went out in like November. So this is a significant improvement. And they know that this is, very important to us and very important to our investors. The technology fund is what is called callable capital. So very different than a capital call. A capital call is like, oops, we need more money. This was unexpected. Some problems have happened. Callable capital is we all agree in advance that we're going to put small buckets of money into the fund at scheduled times. So Lotus is 20% per year for 5 years. The Black Swan Technology Fund came in at year 3. So our investors needed to put in at least 60%. If they wanted to put in their full 100%, they could. The vast majority of our investors did. But for those of our investors that have only put in your 60% so far, the next call would be in 2023, and it would be for an additional 20%. At this time, there is no anticipated capital call. That's not to say that it couldn't happen soon. It's, it's much like real estate. We have letters of intent out to technology companies. If we get some traction on an acquisition, we may need to do a capital call. If that happens, we would have about 6 weeks of lead time to send that information out to you. You could have some time to get your liquidity together. So as of today, we have no plans for that next 20% capital call. If that changes, the moment I know, you will all know. That will go out in email. Our tech funds are pretty small, so we'll actually probably go out with like personal phone calls or text messages to each of you so that you have time to get that capital together. In the tech fund, we have 8 investments in 5 companies. We've had 1 exit. We're going to share that. And we have a distribution going out in about the next 7 days.
Yeah. We're I would say kind of over time. There's a few kind of headlines here. So JOI, we exited with a 33% return on JOI, which I think is just an incredible return for the relatively short time that we were in that investment there. Pay Forward, it was just awarded a $10 million contract from Blue Cross Blue Shield of California. So we're investing in these enterprise software companies that then have large clients that have huge sales cycles. So I did 15 years in enterprise software before doing real estate, and some of our clients, it would take 5 years to get through a sales cycle. So when you get awarded a contract, it's a really big deal because that sticky revenue that tends to stick around for a long time. It's kind of like finishing a multi-year renovation in an apartment building. It's a big deal to get awarded these contracts. And then critically, these contracts, they tend to cluster. So like Blue Cross Blue Shield awards this contract.
And then Aetna's like, well, what are you guys up to?
And then that can be like a 6-month sales cycle instead of a 6-year sales cycle. So that's a really, really big deal with Pay Forward.
Edge is probably the most exciting activity that's happened in the tech fund so far. So this is all publicly available information. Edge has been awarded a $950 million contract from the Department of Defense. So about $1 billion if you round up there a little bit. And because of all of that activity and just the scale of Edge, the stock has quadrupled since 2021. That's the company that we have multiple investments in.
Yes.
So we came into that company, hit some performance benchmarks, invested additional capital into that company, and then part of it has gone public, and then there's been this big contract. So Edge is probably the crown jewel of the technology fund for sure.
Yep, that's the Nicholas in Fund 1 or Tanar in Fund 2 is to Edge in the tech fund.
Yep, absolutely. Someone asked about the K1s that went out last year for Lotus. It's my understanding they went out like 1 day before the filing deadline. But like, let's say I get the K1 from Lotus 1 day before the filing deadline, I have to then turn around and get those out to my investors. I'm not exactly sure what happened. It was just a non-negotiable as we entered in our relationship with Lotus that would not happen again. It's a large fund. It's a $165 million fund. Lotus Fund 2 was a $32 million fund. So they've grown substantially, and the growing pains that come with that amount of scale. So that's what led to some of the accounting delays last year, but they've remedied all of that. And that was a big part of us agreeing, to enter into this relationship with having our tech fund, is that K1s would not be that late, ever again.
Yep.
So all good questions. I think as I'm kind of scrolling through everything, I think we've hit I think we've hit all of the questions, if not most of them.
So another question, when do we expect Fund One to get principal back? So, I think they asked that question. We were talking about how we have like that 10 million, no interest, no payments. So we'll probably get some sort of significant cash out refi from the single family homes at some point in the next couple of years. We're returning 10% capital now. Maybe we'll get, I don't know, another 10% in the next year or something like that. Just kind of on that cadence that we've talked about before. But Fund One will have kind of a unique footprint that we're accruing equity in Nicholas, and we're not in a hurry to do a cash out refi on that asset. So it might take more time to get a full return of capital, but there will be a larger return of capital and then some whenever that big payday does come. And then Fund One is invested in RDS, which is just getting started. So we had kind of a long cycle time to deploy all the capital in Fund One, which will there will be a longer latency to achieve a full return of capital in Fund One. But overall, we're really excited with our outcomes on Fund One and where we're going to land in the long term.
Yep. So we bought Nicholas, and then we bought all those single family homes, and then we did a cash out refi. And at that point, the fund was only like, I don't know, 8 or 9 months old, maybe a year old. And we could have returned capital at that point, but the fund size would have been, on the smaller side, it would have been about a $30 million fund against $11 million
which
of
is
investment.
Industry standard,
but it's not good
numbers.
Enough for us.
Not for us.
So that's why we made the decision for that capital to go into RDS so that the overall fund size of Fund One could be larger. Someone asked, do we expect room in Fund Three for new investors? I think so. This is a tough question for us because we don't have a crystal ball, and it's all human behavior. So Fund One was a $10 million fund. It filled in a day. Fund Two was much larger. It was a $30 million fund, and it filled more slowly. So there was more time for people to, talk with their spouse and, wait for their quarterly bonuses and those sorts of things. We did fill it in by the end of the year, which is what we were hoping for. Because deal flow is so slow right now, we anticipate that Fund Three will be either 10 or 15 million. It will first go to our existing investors, then it will go to the wait list, and then it will go public. If I had to guess today, I would anticipate that Fund Three will fill in less than a week, but I don't really know. And you kind of never know. But I get the sense that we will have room for new investors. But it will also be, what I tell people is listen to these presentations, go back and listen to our other quarterly webinars, look at the stuff that Rachel's putting out, follow us on social media, have calls with Nick and I. Do as much of your due diligence as you can so that when you're making a decision for Fund Three, you're really just saying, does this deal follow their regular pattern? Is this a deal that I'm excited to get into? But you already understand the fee structure, that there are no fees. You understand the payback period. You understand infinite rate of return. You understand our business plan so that you can make that decision quickly. So good question there.
Excellent question.
Some announcements. We have some community power hours, May 22nd. So just a couple of weeks away at 7:30 p.m. Central. June, we're flying all over the country, speaking live in person on stages. So we're taking a break virtually. July 10th at 7:30 p.m. Central and August 7th at 7:30 p.m. Central. These next 3 presentations will be communication, our timeless principles, and
are we doing polarity?
That's communication, our timeless principles, and seasons. Thank you, Rachel. Those are our 3 highest rated content, the stuff that everyone wants to hear. So we're just kind of stacking them all up together this summer.
A hot summer.
It'll be super good. That is all of our slides. There's our contact information. If you need that, you guys know how to reach us. meetblackswan.com is our calendar. I will say our calendars are pretty much blocked through the summer as we're supporting our leasing team. That does not mean we're not available. It just means email Rachel and she'll give you slots on our calendar. But we're just trying to make ourselves as available as we can to our property management staff during the heat of this busy season.
I'm going to jump off this call and literally go look at 100 lease renewals with our kind of renewal officer. Like we're in the thick of we
grew 20% in the last 3 weeks. So you can't do that and then not support your people. So we're eager to support that, but we're eager to support you as well. So if you go to Calendly, it says there's no appointments available, but that doesn't mean we're not here for you. Email Rachel and she'll get you a spot. Any other questions that anyone wants to drop into chat? I'll kind of give a minute here for anything that might come in, and then otherwise we will wrap up. We appreciate your time if you were able to hang with us all the way to the end.
Relatively on time for 66 slides. We covered a lot of ground. It's been a really, I hope we have less busyness in the future. This has been a long quarter.
We'll get less busy when we're like 80. Thank you. I appreciate that compliment. We're excited to serve you guys. We're excited to share these updates. Excited for our in-person event where you can really see, touch and feel and smell and be a part
Yeah.
of the action, the meeting
Man,
our team.
RDS is gonna be an amazing,
L-
I hadn't
looking
thought
at the
about that.
buildings
We'll have RDS open for the event. That event is gonna be, we could probably host the event at RDS if we really
Probably
wanted
could,
to.
probably
That'd be-
could.
Yeah.
Yep,
a big old
absolutely,
building.
absolutely. Question popped in. What is the minimum investment for Fund 3? Our minimum investment is 100,000. Good question. I think that's a wrap. Thank you all so much for your time. We're here for you if you need us. Grab us on Facebook, whatever you need. Thank you so much. Have a great rest of your day.
Bye.
Bye, everyone.